Welcome to Bullshift, the podcast, where we talk about behavioral finance from the perspective of the financial services industry, shifting your attention to make you feel more bullish. My name is John DeGuy. I am the author of the book Bullshift and the host of the podcast. My guest this week is Jean-Paul Pureau, and JP is the Executive Director, President, and CEO of FAIR Canada. FAIR stands for the Foundation for the Advancement of Investor Rights. He is a long-term veteran of the financial services industry and a former executive member of the Management Committee for the Ontario Securities Commission. Welcome, JP.
Thank you, John. Nice to be here.
I'm wondering if I suspect many of the people listening in today don't know who FAIR is. So I'm wondering if you could maybe take a few moments to outline the mandate of the Foundation for the Advancement of Investor Rights.
Sure, I'd be happy to. So FAIR was founded in 2008 after the global financial crisis. It is Canada's only national nonprofit corporation whose mission is to focus on advancing the rights of individual investors in Canada. Uh, as a nonprofit, we have a board of directors, and we try to recruit directors from across the country, given that we are national. Um, and we have, up until recently, I had 3 employees. I just recently hired 2 new employees. So with me, we have a total of 6 employees. Um, and our mission is to advance the rights of investors in Canada. And we were primarily set up to act as a bit of a counterweight to the just the extensive amount of industry associations that are out there, who are very capable and well resourced, and who often submit comments and make submissions to governments and regulators when there are proposals to, introduce new requirements or amend existing ones. And so we work very hard to try to provide an informed perspective, but focused on the needs and the experiences of individual investors in terms of trying to get that balance right.
I know that I've personally made a number of submissions to regulators when they request comments on those sorts of proposals and rule changes and new ways of doing things. Could you perhaps provide maybe a little more specificity, put a little bit of meat on the bones? Can you give me 2 or 3 or even 4 examples of what sorts of things FAIR might be commenting on and what positions FAIR takes?
Yeah, no, I'd be happy to. So, in any given year, there are dozens of regulatory proposals. One of the things we monitor all the different proposals, and one of the things we try to do is to identify those proposals that are going to have a real nexus and a direct impact on individual investors. So we tend to get less into market trading issues and more into, for example, disclosure that's client facing. We certainly comment a lot on the advisor client relationship issues. And we're also been doing a lot of work on the complaint handling system as well. So these are different areas where obviously there's a clear nexus with individual investors, and there are issues that affect them directly. So many different examples I can give you. Recently, Ciro has been developing a proposal to change the way it approaches proficiency in terms of the advisor. And so it's moving from a course-based approach to a competency-based approach. And that's something that we have commented on, just given the importance of the relationship between the advisor and the investor ultimately. We've also done a lot of work on complaint handling. So we very happy recently with the federal government's decision to appoint OBSI as the sole external complaint body for banking complaints. I think that'll go a long way in terms of trying to streamline what is a fairly complicated process for individual consumers to navigate.
I'm wondering if we could maybe just take a moment to spell out what CIRO is and what OBSI is, because a lot of people listening won't know, and
Ah,
I'll let you you've used the terms, so I'll let you just spell out what the acronyms are because, viewers wanna know.
okay, so Ciro is a relatively new entity, although it's basically the amalgamation of two self-regulatory organizations that have existed in Canada for quite some time. One of them being IROC, which was the Independent Investment Regulatory Organization of Canada, I believe. And it focused really on the full service dealers. The other entity that amalgamated with IROC is the MFDA, the Mutual Fund Dealers Association, which oversaw mutual fund dealers in Canada. So those two organizations came together, amalgamated at the beginning of this year, and the new name or the name of the new organization, CIRO, which is the Canadian Investment Regulatory
Organization.
Organization.
Yeah.
Uh, OBSI is another acronym, and there are tons of acronym in this space. But OBSI is the Ombudsman for Banking Services and Investments, and they handle both. They're a not you know they're a third party independent ombud service that deal with both complaints against banks and complaints against investment dealers.
November is Financial Literacy Month, and we're just getting a chance to get this out on the air before the month is over. So I figure it's still fair to ask you about financial literacy. What would you say are the touchstones of financial literacy in Canada right now? What are we good at? What are we not so good at? What can we do differently?
Um, Great question. So I think there's a tremendous amount of really good materials that are available over the internet on different websites that are helpful to investors who are trying to educate themselves about various aspects, whether it's trying to deepen their understanding of different types of products, different types of fees, there are fee calculators. So there's a lot of resources out there, and I think a lot of good materials. So I think that's what we're good at. I think what
Mhm.
we're less good at is actually getting this information to investors in a way that helps to empower them. So my own view is that these materials are great, and they'll be used by a few people who take the initiative, who understand that they need more information, and they'll go out and look for it. Unfortunately, that's not the majority. I think the majority are more they're not entirely sure they actually need more information, or they'll stumble along the process. So I think we need to find a better way to educate investors in Canada. From our perspective, governments many decades ago took a decision that individual Canadians should take responsibility for saving for their own retirement. And that policy choice has been taken. I think now it's incumbent on governments and regulators, and the industry for that matter, to really do a better job of educating investors and giving them the tools they need to better navigate what is a really complicated regulatory system.
One of the things I talk about frequently in this podcast is this notion of bullshift, where the industry says things which are oftentimes presumptively true, but not necessarily true full stop, or at any rate, misleading in that they say things that might work, but might not, and they would have an overlay of a sales pitch that gets people to open their checkbook or their wallet to do things that otherwise they might not otherwise do. And those are usually things that are good for the industry's bottom line, but not necessarily good, not necessarily bad either, but they're the word that I would use is amoral. They are amoral toward investor outcomes, but they're certainly accretive to industry outcomes and industry profits. Are there things that you can think of as perhaps as examples off the top of your head of things that the industry says or does that are good for the business, good for the financial services industry making money, but maybe not always that great for retail investors?
Sure. Well, I can think of one specific example. And I think one of the things that investors have to understand is the financial services industry uh, is, as much as it's trying to be professional, and there are lots of good advisors out there, you have to think about how they get paid and compensated. And there are a lot of concerns around the fee structures and the compensation structures because a lot of investors assume that the person they're dealing with is actually working in their best interest and is giving them advice that is really in their best interest and solely their best interest. And in some cases, that is true. But in other cases, um, the advisor has an incentive to sell certain products over other products because of the way they compensate the advisor. So, a great example of that is um, where it came to mutual funds that had what they called deferred sales charge commissions.
Mhm.
And these were created, I don't know how many decades ago, and they were used heavily by the industry to sell mutual funds. They were easier to sell in some ways, but they were recently banned by regulators because they were deemed to be unfair and they produced poor outcomes for investors. So DSCs, or deferred sales charge commissions, were basically a mutual fund where the investor did not have to pay a commission when they bought it, but the advisor got paid the commission nonetheless. It was paid by the mutual fund manager to the uh, to the advisor, and that was helpful to clients. You know, when you have $1,000 and you want to buy a mutual fund, you don't want to be told that $100 of that investment is going to go to pay the advisor's commission.
Mhm.
And so they would prefer to buy these products that had the appearance that they weren't paying any commissions. And who could argue with that? The
Mhm.
problem is, though, these mutual funds had time period, usually 5 to 7 years. And if the client wanted to sell them during that time period, they then had to pay the deferred sales commission, and that led into all kinds of problems. So there's an example of where there's some bullshift happening out there that
Right.
people have to be aware of.
Up until now, we've been talking about people who work with an advisor. Are there things that FAIR does, and maybe not, but are there things that FAIR does to help do-it-yourself investors as well, or does FAIR work exclusively with people who work with a financial advisor as an intermediary?
No, we try to represent the interests of both types of advisor or investors, regardless of which channel they kind of go through. Our main focus is on individual investors, regardless of which distribution channel they're working in.
Okay.
So, obviously, when you're working with an advisor, we put a lot of focus on the proficiency requirements, the education requirements, uh, the disclosure that the advisor is giving to the client, explaining what they can and cannot do, what products they can and cannot sell, even what titles they're allowed to use.
Mhm.
On the do it yourself or self directed um, investors, uh, first of all, we've seen a real spike in the number of do it yourself accounts, especially during COVID. And we're trying to get a better understanding of who is the do it yourself investor, how much knowledge do they have, how are they making their decisions. um, so there's some data that shows a big spike in the number of do-it-yourself trading accounts that were opened. We suspect, though, there's far less actual trading going on by do-it-yourself investors.
Mhm.
So we're trying to get a better picture of that. And we're also trying to make sure that do-it-yourself investors understand, um, what rights they have
Mhm.
and what kind of protections they may have, but more importantly, in that space, what they do not have in terms of protections.
We spoke a few moments ago about SROs, self-regulatory organizations, and we mentioned that CIRO is now the main SRO in Canada because of the amalgamation of the Mutual Fund Dealers Association and the Investment and Industry Regulatory Organization of Canada. The primary mandate of self-regulatory organizations is to promote the fair and efficient functioning of capital markets. And that is a broad-based terminology that means different things to different people. Wondering if you could weigh in. What do you think? How well do you think SROs are promoting the fair and efficient functioning of capital markets in Canada?
I think in terms of the fair and efficient capital markets, they're doing a reasonably good job. And it should be Zero.
Yeah, that's me. Yeah.
Zero's doing, I mean, they have a very strong market surveillance function. And they have a whole set of trading rules that really regulate how trades are put into the market, best execution of trades, and things like that. And I think on that, at that level, they've done a very good job of kind of rooting out the worst kind of behavior in the marketplaces. Um, I would actually emphasize Zero it also has a mandate to act in the public interest and to serve the public interest. So some of the, depending how well they do, kind of depends a little bit how you define success.
Mhm.
I think Zero, having just been really created at the beginning of this year, has done some good things. We look at it more from the perspective of what are they doing to serve the public interest, including investors.
Mhm.
And so they've taken some early steps to create an investor office, which is going to provide, we hope, some policy input into how they develop rules and how they set their priorities. They've created an investor advisory panel composed of people with some knowledge about investor issues to give some advice to their board and to the organization as a whole. So those are all very positive developments. But time will tell. There's a lot of work underfoot, including, as I mentioned, they're trying to review and propose changes to their proficiency requirements. We'd like to see a strong and robust enforcement program where not only are they taking appropriate action against individual representatives, but also the dealers who are failing in their obligations to supervise or implement,
Mhm.
uh, P's and P's, policies and procedures, things like that. So I think, in terms of the market trading thing,
Mhm.
I think they're doing quite well. I think in terms of serving the public interest and protecting investors, time will tell.
In terms of investor protection, there's one thing that I think is quite difficult to guard against, and that is advisors who are misguided. So about 7 years ago, a research paper came out that showed that people on the MFDA side, on the mutual fund side, which may or may not spill over to the securities side, but we don't know. The research was only for the mutual fund side, showed that financial advisors had quote unquote misguided beliefs. They believed things to be true, and they were doing it with their own accounts, even though the evidence showed that these things are in fact not true. So advisors are not being sneaky, they're not trying to cheat anyone, but they are nonetheless giving bad advice unwittingly. What would you say could be done to deal with that? And I know we talked about this a moment ago about the industry moving toward regulation based on exams and competency rather than a demonstrated ability to know things. What else do you think could be done to actually protect consumers from advisors who, despite their good intentions, are giving advice that is less than ideal?
Well, I think that's going to be a harder nut to crack. I think some of it is, for example, in the zero proficiency proposal, they're talking about continuing education requirements, where zero will actually set some of those topics and themes every year that they're expecting advisors to educate themselves on. So that might be an opportunity to try to correct some of these misguided
Mhm,
views.
mhm.
I'm not sure. I think, though, a lot of the responsibility is going to fall on the shoulders of the investor themselves. I think they're going to have to find a way to ask questions, be comfortable asking questions, and not take whatever their advisor is telling them as the gospel. There's no single one way or right way of investing. And I think, just given the importance of it, um, I think investors can take some responsibility to try to ask questions. Like I said earlier, educate themselves, and periodically maybe go to and see if they could get talk to another advisor
Mhm.
and have them look at their portfolio and say, "What do you think? Do you have any feedback?" And that might be one way to counter that kind of situation.
I asked the question a little bit self-servingly because my previous book, Stand Up to the Financial Services Industry, delved into this question fairly extensively, and my other website, standup.today, actually has questions that you can ask your current advisor if you're an investor who wants to get to the bottom of what people think and why. So there are resources out there, as you say. You're a busy man. There's a lot going on, and I'm wondering if you could perhaps share with people listening today what you've got coming down the pike in 2024.
Yeah, so in terms of things, 2024, in terms of policy focus, one thing we're keenly focused on is improving the complaint handling system as it relates to complaints against dealers. The CSA have announced that they were going to be publishing a proposal by the end of this year. So we're going to be obviously very focused on that. The proposals is relates to the extent to which recommendations that are made by the Ombuds Service will be binding on the dealer firms should the client accept those recommendations. So this is something that's been discussed and debated in Canada for well over a decade.
Mhm.
We're falling behind in terms of our international peer group, and we're looking forward to that regulatory proposal and to see how far we can go with it. We're also, as I said before, very focused on trying to enhance the proficiency requirements, trying to address a lot of issues around title usage, confusion of titles. Um, we could have a whole separate podcast just on that.
Sure.
So those are some of the policy issues. But in terms of kind of areas that, in terms of the organization where I'd like FAIR to go and do more of, it's really in the area of research. So we are just starting to do. We've done a couple of surveys of investors, trying to hear from them directly about their needs, their experiences. What is this experience like for them when they interact with the regulatory system or the industry? We've done some focus groups as well, which is more qualitative in nature in terms of the feedback we're getting, but it's providing us with a lot of real insights into the level of knowledge and understanding that everyday Canadians have in terms of the investing um, process. And we're also doing some statistical or economic data analysis to try to better understand how many investors there are in Canada, how much do they have invested, where are they investing, things like that. So that's going to be a big focus for us in 2024, is trying to do much more research. And I think the third area is really trying to raise awareness. One of the things we are trying to do is find ways to demystify the system for everyday Canadians who don't have the time, or nor for that matter necessarily the inclination. So we're trying to help explain what is actually a very complicated, sophisticated regulatory system in a way that they can better understand. And we're just trying to raise awareness as well about what their rights are, and what they can expect when they're either dealing with an advisor or they're working on a do-it-yourself platform.
It sounds promising, and I want to encourage you to keep going because I do get the sense that we're making progress in Canada. It's slow, it's cumbersome, but it is progress, and that's encouraging. So that's great. got to wrap this up. So let's see if we can go to the thing that we always end with. And the first of the two things is that's bullshit. If it was up to you, JP, what is the one thing that you would say is bullshit in the financial services industry? The sort of thing that if you could change it, you would.
Well, I think I could pick a few different areas, questions. I think I'm gonna for today. I'll just talk about something that's happened to me personally, and I know other people have complained about, and I really do think it's bullshit. So I had a trading account which I cashed out. I
Mhm,
wanted to transfer that account to another account within the same corporate family,
mhm,
but two different, I guess, business lines. And it took over 40 days to transfer money, cash from one account to another account. And that is something that for more than 40 days I had no access to my own money. Um, and I you know, had lost some opportunities in terms of the market and everything else. And I understand that's an issue where investors are trying to switch dealers, um, and it's really annoying because uh, we want to promote uh, competition. We want people to take more control of their investments. We want them to be able to move between advisors if they're not happy with their current advisor or whatever. And issues like this just create a ton of friction in the system. And it's very frustrating because, it's the financial services industry that often talks about, innovation and we want to innovate. So I'd like to see some innovation around these kinds of issues.
so then that brings us to the second half of the equation, which is shift happens. If it was up to you, how would you what exactly would you do to expedite transfers from one firm to another and to innovate in order to make these things more consumer friendly?
Well, I think, maybe regulators need to have some conversations with the industry, maybe provide some guidance to really encourage much more timely and efficient transferring of accounts. I think it's really important. If we want to promote choice and we want to encourage competition, we have to remove the kinds of friction points in the system. And so I don't know if guidance would be in order, but I think we need to take a deeper look at some of these issues, which are simply in this day and age are hard to fathom why it would take so long.
Great. I want to thank you for joining me today. It was a real pleasure, and your insights are certainly much appreciated. And for the people watching at home, I want to encourage you to like and subscribe because we need those eyeballs and we need to get some numbers up. So that's great for our own algorithms and support. Thank you, JP. It's much appreciated.
Thank you, John.
John DeGooey is a portfolio manager in Toronto and the author of the book Bullshift: How Optimism Bias Threatens Your Finances. Bullshift is available online and in bookstores everywhere. The opinions expressed in this podcast should not be construed as investment advice. Bullshift, the podcast, is produced by TalkShoe, a division of IOTM.